Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. This segment is brought to you by my company, Bull Realty, for client-oriented asset and occupancy solutions. Give me a call or visit bullrealty.com. Today we're talking with Anthony Graziano. He's CEO of Integra Realty Resources about Viewpoint, their annual report. And I'd like to ask you about your how 2019 did and what you see moving forward for multifamily. I mean, it seems like is there an end in sight there?
Look, the multifamily velocity over the last few years has been tremendous, and every year everybody says cap rates are going to have to go up. They're as low as they could possibly go. We have to stop building, and we haven't. They haven't, and we probably won't. Look, the trends in multifamily have been and remain, I think, very positive. Some of that is, as I discussed before, resulting from demographic changes, right? We're more of a tower. The younger millennial generation isn't buying the single family homes the way they were, and they're migrating, delaying their decisions to have babies and get married, and so multifamily is a natural option for them for longer, right? They don't stay in an apartment until they're 24, they're staying in an apartment until they're maybe 30 or 34, which is giving you a longer tail. The amount of single family housing creation is down, and we are seeing more multifamily built in the downtown urban areas, which I think is a long-term benefit. But it's really at the higher end of the spectrum. So a lot of that is new construction that has an experience, that has very highly amenitized. We've reached a point where a lot of these apartment projects are at a quality level of what we used to build condominium buildings for.
Exactly.
And so when you look at the pricing on these units, you're getting a lot for your money, and your long-term goal is to just have a good place to live. But at the same time, we haven't done a lot in terms of creating good quality, affordable housing at the multifamily level. So construction has been high in a lot of markets. We're monitoring that. We talk about it in Viewpoints. Certainly when we're doing the work on the ground level, we're always looking at the supply side. There are markets this year that will start to see rent leveling off or even decreasing, a result of new supply coming online. I think for the last probably year and a half to 2 years, the lenders have been much more stringent when they're looking at the combination of supply, demand, as it relates to rent growth. So we haven't seen a big jump in the capitalization rates, but again, that's because there's a lot of money behind apartment investment, and the investors desire to own apartments. They think it's the safe haven of all the commercial real estate asset classes traditionally. So we've seen a good amount of money behind a multifamily development. But the other thing that's buoyed the market is the short-term rental trends. When you look at the Airbnbs and others, a lot of there's the national sort of short-term rental groups, and now there's a whole subset of users, Saunders, Domio, and others that are actually going into new apartment complexes that are being built by institutional developers, and saying, hey, we'll take 30% of the units or 40% of the units on a master lease. So the absorption of these newer projects is being driven by some of these short-term rental operators, and they're charging hotel rates. So they can pay market rent, full market rent for the unit, furnish it, and then rent it out. That's also creating some shadow hotel inventory in a lot of these markets. And in markets that are very land constrained and hotel constrained, or where ADRs are really high, take Nashville, that's a very successful strategy. The downside is you don't really have an apartment. You sort of have a hybrid apartment hotel, right? People are moving in and out every weekend. And so we'll see if those operational risks withstand. But overall, all of those various pressures, the apartment markets remain pretty strong.
Yeah, well, it'll be interesting to see the impact of that, because if I live in an apartment and I think people have annual leases and I see people moving in and out every day.
That's right.
It's like I have some condos down in Florida in buildings that are all pretty much residents, and I have a condo in a building where there's more transient people staying overnight, and it's a different environment. I mean, you see people walking around with, in the morning with kegs of beer,
Yeah, no, I know.
Six packs.
Even walking in with the suitcases, but I mean, it adds to the wear and tear, right? I mean, the level of maintenance that a hotel garners is different than the typical level of maintenance that you put into an apartment.
Right.
And so you can't really operate an apartment like a hotel and not expect that to affect your operating costs. But the bigger issue is in condominiums, it's a bit easier to control, right? You call the condominium association board together and you vote to not allow short-term rentals or otherwise. With the apartments, it's profitable for the landlords to do it. And so the only recourse is whether they start to suffer, occupancy or rent declines on the balance of the full-time residents. But the other thing is, obviously, a lot of the communities are resisting the change as well. So you've seen an uprising of community involvement in the management of the short-term rentals. In really high-value markets, in California, in New York, we're also starting to see rent control dialogue leak back into the politics of the day, right? How do we create affordable housing in San Francisco? Well, let's rent control it. But the reality of it is that tends to put more constraints on supply, which over time exacerbates the problem. It also then, because of the constraints on supply, doesn't require that the landlords maintain the units at the same level because they don't have to be competitive because there's no risk of competition. So I think that this reaction to high rents, to rent control is going to be an interesting sort of redux of what we saw in the 1960s and 70s. And it's going to take a while to play out. But we don't believe that that's the right strategy in the long term. We believe supply creation is the right strategy in the long term. And so for the communities that we consult with, we're advocating changing the expectations of density in certain markets to allow more density so that the house more sort of low-rise, multifamily, 3- and 4-story infill can be developed. Changing the parking requirements. A lot of the hurdles to creating affordable housing rest on the regulations and the cost of regulation in a community. And so, we consult with a lot of communities and counties on these types of issues, right? The supply and demand and what could change the development pattern. And so we always say, look at your parking requirements, look at your impact fees and your other regulatory hurdles that keep you from developing affordable housing. And then ultimately, what are the incentives to develop for the middle? It's not as profitable to develop for the middle. But I will tell you, there is an untapped line of people waiting for good quality, mid-scale housing. And a lot of it is just a combination of land cost and construction costs that if we could just get those costs down 20 or 30%, we could build for that affordable market. And whoever figures out how to do that, the world will be beating down their door. Yeah,
well, it's a good point. I think affordability is becoming a problem too for these Class A communities anyway. I mean, how many tenants can pay, $3,000-4,000 a month for a studio, and actually afford to pay it? Well, let's jump to hospitality. You mentioned hotels already. How did hotels do in 19, and what do you guys expect?
So 2019 was a difficult year for hotels. ADRs across the board were relatively level. RevPAR declined slightly in some markets, or was up slightly, 1 or 2%. It was not a banner year for hotels, but we've been having year-over-year successes in that segment, and so everybody's building. If you look at the amount of construction, a lot of what's going forward into next year, we're saying the warning signs of retrenching on rates is going to happen in 2020, just because of the sheer number of units that we're creating in the various markets, and the fact that any change in the economic status, the first thing to hit is the U.S. discretionary dollar for travel. So, business travel is up because the economy is good. Domestic leisure travel is up because the economy is good. And when the economy is not good, those two things suffer immediately. And you combine that with increasing supply. We're cautioning, both our lender and investor clients to really look hard in the market and be rational about what the expectations are for 2020.
So rental rates could drop in some of these properties.
Yes.
And is that more in the limited service type hotels, or is that other types as well? Is that full service?
It depends on the market. I mean, certainly there's been more construction in the limited service sector. So I think just on the supply side, the limited service sector is much more exposed. We've seen a lot of that ADR and RevPAR growth in that sector, primarily driven by business travel. A few years ago, you could go to a normal all suites hotel or any type of limited service hotel. Your rates were $125 to $150. I can't get into an airport hotel now for less than $180 to $200 a night. $200 a night used to be your leisure travel overnight stay in a major metro market. That number is now $300 or $325 or even $400 in some cases. So it's just the repricing of the hotel market has been great for the early investors and those that have participated in the market over the last 5 or 6 years. But now that we're building into this next cycle. We just need to be smart about where we're going to be.
Okay, so I guess then you're predicting there's a chance in some of these markets that some of these valuations could drop a little bit if the rates are going to drop.
Yeah, I think we're looking at that, and we're absolutely sensitivity testing those.
Yeah, okay, well, excellent. Well, what would you leave our audience with about Viewpoint and kind of the theme and what they should think about moving forward?
So, look, I said in my closing, I think that it's going to be a good 50% chance we're going to have a good year. And I'm very hopeful that we continue on this trajectory. At the same time, we're here for you, right? We do, our primary business is to give good, sound, independent advice based on the things that we know in the local market. All of our offices are serviced by local market professionals that have been there a very long time and know what's happening across the street and across town. So rely on your professionals and take advantage of us, and we'll hope to work with you.
Excellent. Well, thank you for coming on the show. We appreciate the information from Mr. Real Estate.
As always, a pleasure, Michael. Thank you.
If you'd like to see the actual report, visit their website. It's IRR.com, IRR.com. We'll also have a link at our show website, CREshow.com. Well, thank you for joining us around the country. If you're watching or listening, please join us on social media and leave us your comments. Please share the show and contact us anytime. Well, until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For customized asset and occupancy solutions, visit bullrealty.com. Commercial Agent Success Strategies. Incredible training for commercial agents. Visit commercialagentsuccess.com.